Oh man, this stuff is really dense. So let's continue with cash and receivables. A company has the following cash balances. What is the amount of cash and cash equivalents that should be reported? Large bank account, small bank account. The Continental negative 42,000. Petty 450. The treasury bill, I believe, should be considered as a cash equivalent as well. Although I could be wrong. So the answer is okay. Okay, so the Continental isn't going to be considered as cash equivalent. Okay, a company has the following items at year's end. What amount should be reported? So, cash in the bank, obviously. Petty, 100. Short-term paper. But the checks are not going to be considered to be cash equivalents. Next question is cash in the bank, 35,000. Petty, 300. Short-term paper, 5500. 40,800. Cash on hand. Oops. Cash in the bank, cash on hand, not this. So the certificate of deposit is not going to be considered to be a cash equivalent. That's more important to know. A company has cash in the bank, 20,000 restricted cash. How much should they report in cash? 23,000? No. Okay, 20,000. And this stuff is oh man, it's really dull, I'll tell you. So number 6. Company has cash in the bank of 10,000 restricted cash, 1,000 bank overdraft 3,000, and has in the same bank houses 10,000 cash. So I believe they should report 20,000. Oh. The company has the following items. How much should be equivalent? Cash 10,000 petty. Um, all the following may be clear under the heading of cash except for the money market account funds. Which account are post-dated checks received classified? I believe it's prepaid expenses, or no, it's payables. It's receivables. Under which section of the balance sheet is cash received from tenant expansion reported? I believe that's gonna be probably current. Non-current assets. A bank overdraft from a different bank should be. It's the probably. Bank overdraft from the same should be deducted. If it's not the same, it should be deducted. What is restricted cash segregated? What is restricted cash segregated from the balance sheet? What is restricted cash segregated from on the balance sheet? I believe B. Company receives 3-year 20,000 zero interest bearing note, present value of 16,000. What's the journal entry? Let's see. So they received the note, so NP, well, most likely not receivable. 20,000. Who knows what they gave it out for? Okay, well they'll get back cash, clearly. I suppose they'll be giving with cash. Present value, so even though it's zero interest bearing, there is some kind of implicit interest value. Company receives a 7,000 non-interest bearing note from the sale of inventory. The market rate. Time of sale 8,000. The note is due in full at the end of 3 years. Assuming an annual interest rate 8% for 3 years, appropriate present value of principal. Assuming an annual interest rate of 8% for 8 years. So they'll receive that 7,000 no receivable inventory of 5557, and because it's going to be at a discount, so debit no receivable, credit suppose credit revenue. Okay. Cover issues 4 years or interest bearing still inventory, so you got interest for 4%. So MP 4,000. Sale, I would say, of inventory 3,419. 4,000 minus 3,419, and discount credit revenue. Company sold goods in exchange for a 5,000 2-year interest-bearing 0% interest-bearing note. The note is issued high-risk customer, and the market rate for a note of similar risk is 7%, assuming an annual interest rate 7% for 2 years as appropriate. Present value. Okay, so they exchanged, they sold the goods, they received the note, received no payable, no receivable. 5,000 revenue, credit revenue. Credit revenue of 4,367. Discount 63. The company sells 2 lamps to a customer on open account for 2,000 each. Lamp sells for 1,000. 1 month later, the customer returns the lamp on open account. So I suppose that's like an accounts receivable. So accounts receivable of 2,000, and then I suppose inventory of 2,000. Then most likely they'll do sales return of 1,000 and inventory thousand. Okay, well I suppose I guess they'll return it back to the AR. Okay. Company has sales of 12,000 and sales return allowances of 200. What should the company report as net sales? The net sales is gonna be the sales minus the returns and allowances. So the sales return allowance account is a contra asset account. Contra revenue account. Journal entry to record return of goods from customer is debit sales and return allowances. A company has the following financial information. What is the accounts receivable turnover? So account turnover ratio, we have to get gross sales minus the return and allowances, and then you get the average AR, which is the beginning and the ending, divided by 2. So 1,000 divided by 2. Divide that. 17.56. Company has the following information for a period. What is turnover ratio? Turnover ratio. Doubtful accounts. That credit, bad debt expense, the write-offs, present value of the note.